I've been meaning to ask you this. One of the things I don't think that I've heard anybody, any of you realty experts from Berkshire Hathaway talk about, but is it possible, like, because I've seen it with vehicles and things before, can you take over someone else's loan, like a mortgage? Can you take that over from, say, you say to me, John, I don't even want to be here anymore, but I still owe some money on it. You just want it, just take over the loan.
Yes.
Can you do that?
Yes.
One, the only, the realty expert, John Brodeen.
Hey,
I don't know if you're really itching to get going, but
no, it's
it
good.
just kind of whatever came out, you know. How you doing, man?
Good. It's good to be here.
Yeah, how's that kid doing?
Awesome.
Yeah.
Good.
All ready for spring?
Yeah, it's coming.
Yeah, they say that.
The days are getting longer. The time change that threw me off.
It kind of messed me up, too. I was kind of liking that going to work where I could see in the morning.
Yeah.
And now it's pitch black again. But, I mean, I don't care about how late it stays light at this time of the year because I don't do nothing outside anyway.
That's true.
Yeah.
It is crazy, but it's not getting dark at 4 o'clock in the evening.
No, and that's kind of nice.
Yeah.
You go to work, it's dark. You get done work, it's dark.
Yep.
It's, the whole, just like the rest of your life, right? Left in the
Exactly.
dark.
Yeah.
I've been meaning to ask you this. One of the things I don't think that I've heard anybody, any of you realty experts from Berkshire Hathaway talk about, but is it possible, like, because I've seen it with vehicles and things before, can you take over someone else's loan, like a mortgage? Can you take that over from, say, you say to me, John, I don't even want to be here anymore, but I still owe some money on it. You just want it, just take over the loan.
Yes.
Can you do that?
Yes. So what you're referring to would be an assumable loan.
Okay.
So typically FHA loans and VA loans are both assumable. And so the reason this is important right now is we just got through a stretch with historically low interest rates, and it's quite possible we'll never see interest rates that low ever again. And I'll talk a little bit more specifically about VA assumable loans because I ended up doing a bunch of research on this for a client of mine.
Okay.
So I learned some stuff I didn't know before. VA loans are assumable. Basically how it works is whoever is servicing that loan, it's not always the company you got the loan through.
They sell the loans or whatever. Yep.
So whoever has the loan right now, you basically apply through them to take over the loan. The seller has to be okay with it. Seller has to give permission. Mm-hmm. And, you're obviously, if they purchased during low interest rates or they refinance during low interest rates, you're going to be able to get a much, much better interest rate than what you're able to get right now.
Okay, so that interest rate from what they signed off on
is what you
stays
get.
with it. So, okay.
So it sounds really simple. There is kind of a catch, though.
There's got to be.
Yep. So let's say they bought that house 4 years ago.
Okay.
And, they've paid off $20,000 of the loan and it's selling. So let's just say, they bought it for $210,000. They owe $190,000. Mm-hmm. You're now buying it for $225,000.
Okay.
You have to make up that difference between $190,000 and $225,000 as basically a down payment. So you do have to have a larger down payment. So people who don't have very much cash, this isn't going to be a great option for you. But if you were planning on making a larger down payment anyway, and you'll be surprised to hear this. So if it is actually possible for a non-veteran, so somebody who doesn't qualify for a VA loan, to assume a VA loan. But there's one problem. The seller, their VA benefit is tied up in that home until the new person either sells it or refinances it.
Oh.
So
even though they're not there anymore.
Even though they're not there anymore, it's still using their benefit. They're off the loan and everything. They don't have the responsibility to pay anymore, but their VA benefit is tied up. So like, let's say, I can't remember what the total maximum amount of VA loans you can have at any one given time is, but at least a couple of years ago, I think it was around 480,000. And I think there's some factors that will make this vary some, but I think it was around that amount. So if you've got 200,000 or 190,000 of a VA loan tied up, then you're down to 280,000 or 270,000 that you're able to use on your next home. That might not be enough. So that's something that people need to keep in mind.
Okay.
But it is possible, but and a seller might not agree to that because they don't want their VA benefit being tied up in that home.
Right.
But it is possible. That was something that really surprised me. More typical would be somebody who qualifies for a VA loan taking over another person who has a VA loan, and in that case, their benefit is, back to being full
Okay.
once the loan assumption is over.
So if you own a home with a VA loan, and I assume that loan, but it's still you because it was a VA loan, what happens if I default on like mine? Does that go back to haunt you then, or how does that work?
No. So if you do, and there's a word for this, I think it's novation.
Okay.
That's pretty much what any actual like above board loan assumption was going to be. That's where you're taking over my loan, right? Is that what you said? You're taking over my loan.
Yep. If you got it with a VA.
If I got it with a
VA
VA loan, you take it over, and you stop making your payments. Well, the bank has basically qualified you.
Okay.
So they've underwritten you. So you are now the borrower. I'm not anymore.
So why is your name still connected to it?
So it's only your VA benefit.
Okay.
So
okay.
So you just wouldn't be able to get
To
another,
use it again.
Like, let's say if you don't have any VA loans out there right now, you've got
Sure.
480,000 worth of VA loan that you can use. So you could take out a 480,000 VA loan. If part of that benefit is tied up in that one house, you wouldn't be able to take out a $480,000 VA loan. The maximum VA loan amount that you'd be able to take out would be, $270,000.
Okay.
Does that make sense?
It does.
Okay.
It does. So now with these assumable loans, you use the example, 200,000 and they've paid 20,000. Okay.
Yeah.
If you had a $200,000 house, you've already paid 20 grand on it, and I'm going to assume your loan, what do I need to come up with then? And
So-
why is that more?
Yeah, so you're basically anything. So the principal balance is what stays the same, and you've paid that down over a few years, right? So the principal balance stays the same. You basically need to make up the difference between the principal balance and the new purchase price.
Okay.
So it's basically like a down payment. The loan amount has to be, if you've paid it down and you only owe 190 on it, the amount owed is still only going to be 190. Because you're not getting a new loan.
Okay.
You're using that same loan. So any difference that is going to go to the seller, and then the closing costs and everything, that's all going to be taken out of the proceeds.
Sure.
And the seller's proceeds are going to be whatever so the seller's proceeds are going to be 225 minus all of the closing costs, and then minus 190. And the seller gets a check for the difference, basically.
Okay. So if you were, say you got your home loan at 3% back when it was historically so low.
Yes.
And I'm going to assume your loan, it's still probably a better deal since the interest rates are up now, paying that a little bit more because you're going to get back to that 3%. Am I right?
Yep. Yes. That's if you have the money to make up the difference, it is going to take a little bit longer. So this might cause some sellers to be a little more hesitant to want to do this, because what I did find out is it can take anywhere up to like 6 months.
Okay.
So
Yeah.
a typical new mortgage is going to take anywhere, 45 days roughly, even less sometimes, depending on how busy appraisers are. It takes longer to do these loan assumptions. I've heard they can get them done faster, but they can take quite a bit longer than a standard mortgage. So,
I'm John. I was kind of confusing myself there, asking you that, and I'm amazed that I get what you're talking about.
Yeah,
because
it's hard to explain.
It is a little complicated,
Yeah.
but that is something I had no clue you could do. And the reason I asked you that is because I've seen it before, where somebody's maybe got a pickup or a newer car for sale, and it's like, you know what, I can't afford it. Take over the payments; it's yours. So I thought, well, why not find out if you could do that with a home or a house or whatever?
Yeah, and then the non-novation type of taking over, type of assuming a loan is a little bit different, and that's not quite as above board, at least from my understanding of it. That would be more like if we made some kind of agreement where I was going to take over your payments, but you would still be responsible for them.
Okay.
So that's much more risky for a seller. And there's also the due on sale clause, where if the bank found out about this, that you had basically sold this home to me and I was making the payments, but it was still in your name, like the mortgage was still in your name, they have a due on sale clause that if they found out about it, they could say, okay, this loan is due because you sold it. And then that
you'd have to come up with all that money.
Then I would have to either get a new loan or refinance it or whatever. So I'm not suggesting that to anybody. I don't know enough about that.
Sure.
But a novation one is where you actually get, qualified. The bank underwrites you. They release the seller from the responsibility to repay this mortgage, and they transfer that responsibility to the new buyer.
Okay, again, using you, John, as an example. And again, I'm assuming your mortgage or your loan. I would imagine the bank can look at me and go, we're not going to let this happen. Can they do that?
They could. It's going to depend on your credit score and your debt to income ratio and your assets. So if you do not have the assets to make up the difference, that would disqualify you. If you didn't have the debt to income ratio, which is basically your gross income minus any, I believe this is the way it is. If somebody want to Google this, just Google like how to calculate debt to income ratio. I believe it's your gross income times like around 0.43.
Okay.
Minus any loan payments that you have each month. So like if you have a car loan that you pay $500 a month for, and you have a student loan that you pay $300 a month for, you subtract that to that number that you get when you take your gross monthly income times 0.43, and that would be the amount that the bank would qualify you for as a total monthly payment, which would include, principal, interest, taxes, and insurance. So that's how you find out if you can qualify for the home or not. That's kind of what the bank's going to do. So they want to make sure you have the income and you're not overloaded with debt to make sure you're going to be able to make the payment. They want to make sure you have the assets, and then they want to make sure that your credit score is going to qualify.
You realty experts from Berkshire Hathaway, we can't phase you guys. We can throw anything at you, and you guys always seem like you have an answer. But again, and I've said this a billion times, I learned something huge here. I've been saying this for a while now. I'm getting to the point in my life where in the next few years, I'll probably be selling because I want to downsize. I want to retire. But I'm glad that you guys come in here and do these podcasts because I've learned a ton of stuff. I mean, a ton of stuff. I never knew that there was a thing called an assumable loan. That's pretty cool. Wow.
Yeah, and for people who are thinking about this, the biggest thing is, first off, you need to find a seller who has an assumable loan. If you're looking to do this, you need to find someone who has an assumable loan and is willing to let you assume their loan. And you need to be able to obviously wait that extra amount of time that it's going to take. And the seller has to be willing to wait that extra amount of time it's going to take, and you have to have a lot more money. So for it to be realistic for somebody, it's probably going to need to be a situation where they bought the home with an assumable, with a FHA or VA loan, probably just a few years ago. Because if they bought it 15 years ago, you might have to come up with a 50% down payment, essentially.
Right. Do you think, John, this is something that is probably a little more popular within families? Like say my mom bought a house and it's time for her to move on, and I'm going to assume her loan. Do you think that happens a little bit more, or probably doesn't have anything to do with it?
Yeah, in my experience, so honestly, this is not a very common thing. I've only run into it a couple times, and the couple of times that I've been involved in a situation like this, it hasn't been a family thing. It's been two unrelated sellers who don't know each other, or maybe they know of each other, but it's not a family situation.
All right. How does somebody get a hold of realty expert John Brodeen if they want to find out more about assumable loans or anything?
Yeah, so if they want to talk, my cell phone number is 701-213-5428. Give me a follow on Instagram, subscribe to me on YouTube. You'll be able to find a ton of content that I make out there. Put out new videos almost every day. So everything buyers and sellers could ever possibly want to know, there's probably a video on one of my channels for it. So,
all right, now here comes one of the toughest questions I've ever asked you. Our anniversary is coming up Friday when you'll be here.
Oh, yes.
You going to have a cold one with us?
I should be able to swing by. Yeah.
You didn't answer my question.
Yeah, I'll help you with you.
All right. There you go. Until Friday, thank you, John Brodeen. He's your realty expert with Berkshire Hathaway. Until Friday, there you go, your Wednesday edition of your Berkshire Hathaway bi-weekly podcast.